Carl, thanks for joining us.
Good to be with you.
The Federal Reserve has held short-term interest rates near zero since the financial crisis of 2008. Do you see that starting to change?
We're certainly closer to positive interest rates than we have been at any time since the crisis started. We've had a 5-year economic expansion in the United States, which has been gaining in strength over the course of the last year. We've had employment results that seem to be getting closer to what the Fed would like to see. And it seems appropriate to begin thinking about removing some of the excessive accommodation so that interest rates and markets can get back to normal.
So when it comes down to it, what will be the key drivers of that decision?
There really are two, and they're the two elements of the Fed's dual mandate, if you will. First is to seek maximum sustainable employment. All the elements seem to be in place for that to be achieved. Lower unemployment, lower numbers of part-time workers who can't get full-time work, lower numbers of people who have stopped looking for work because they're discouraged. And we're beginning to see a normalization in wage growth too, which will also be very beneficial to the economy. On the other side, inflation in the United States continues to run below the Fed's objectives, perhaps a sign that we're not quite at full capacity. The Fed takes that 2% target very, very seriously, and that may ultimately be the thing that holds them back from raising interest rates until later on in 2015.
What are some of the risks that the Fed will need to manage as it moves to normalize its policy?
Well, the first is that the market has gotten awfully used to zero interest rates and a pledge to keep them there. So one never knows exactly how bond and equity markets are going to react when the increase in interest rates becomes proximate. It will take careful communication from the Fed in order to keep the markets from becoming too volatile or rushing to conclusions that it doesn't want the markets to reach. In addition, emerging markets, even though they're far away, many of them, are very sensitive to what the Federal Reserve does because of the impact that that could have on investor flows into or out of those markets. So once again, I think the Fed is going to have to exercise some international coordination to make sure that they don't create problems for the global economy while shoring things up here in the United States.
Some have said that by holding rates so low for so long, the Fed is encouraging financial excess. What's the Fed actually doing to monitor and mitigate that risk?
That's a risk that they need to be cognizant of. 10 years ago, the low interest rates for a very long period of time kindled the credit boom and the housing boom that were the kindling for the financial crisis. The Fed's been scanning the horizon very carefully for signs of excess. None stand out to this point, but they've also done a very effective job of limiting the amount of leverage in the banking system. New bank capital standards have been a key there, and they're not above making pronouncements about markets that they think might be getting a little bit offsides, and to this date they've been very effective.
Well, Carl, thanks for joining us.
My pleasure.
Thank you for listening. For more insights from our economic research team, visit northerntrust.com/view.